Well, good afternoon. Happy Friday. Mark Milam here, your mortgage professional. Let's get right to the week that was. Pretty decent week and a little bit unanticipated. We'll talk about that and particularly what happened with our Federal Reserve. And this is kind of one of those butterfly effect moments that's easy to miss, to not notice what happened with our Fed this past week. Now, the Fed met in a regularly scheduled meeting on Tuesday and Wednesday. Their policy statement, policy decision coming at 2 p.m. Eastern time on Wednesday. No one expected the Fed to change the Fed funds rate either higher or lower, and that's exactly what they did. They held rates completely steady. They didn't go higher, they didn't go lower. Yet mortgage rates have improved on the week to the tune of about 1/4 of a point across most of the note rates. So why did that happen? And this is really an interesting study in recent history, and I'm going to flip the screen around here and kind of walk you through it. We were at a very similar place here on Wednesday as we were going all the way back to September of 2023. And hang with me here. September of 2023, the 10-year Treasury was peaking at around 4.3%. And the Federal Reserve issued their policy statement on September the 20th, 2023. And man, did they come out hawkish, sort of unexpectedly hawkish. Very much, we're going to keep rates higher for longer. The job's not done on inflation. Clearly, we're concerned about the jobs market and wages, and boy, the market did not take that well. The 10-year skyrocketed up to 5%. Mortgage interest rates went up to around 8%. We saw the housing market go into a deep freeze. You may remember this time. This was right about here, and mortgage-backed securities sold off precipitously. And really, in this window, right in here, we saw the housing industry go into the deep freeze because of what happened with affordability. Mortgage-backed securities sold off, interest rates went up, and it was just one of those terrible moments where the Fed badly misplayed their hand. They badly came out and misjudged how the market might react to their comments, and they did a lot more harm than good. We were in the exact same situation this week. We've had 4 or 5 consecutive inflation reports to tell us that inflation's still a persistent concern. We're not seeing a lot of weakness in the job market. The 10-year was right back at that 4.3% level, and here comes the Federal Reserve policy statement this past week, and this happened right here on March the 20th. Yet mortgage-backed securities rallied and interest rates improved on that day. So did the Fed learn their lesson? Absolutely they did. And I'm going to shift over here to the Fed press conference and walk you through a little bit of this transcript. So right over here, the person that's questioning Fed Chair Powell says, just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target? So this is the magic question, because the Fed has been very stern that it's their job to get inflation back down to 2%, and they're going to do it come hell or high water. They don't want their legacy to be Arthur Burns of the 1970s. They want to be the Paul Volcker of the 1980s. So what did Chair Powell say? He said, we're strongly committed to bringing inflation down to 2%. Hang on to your hats here. This is the magic 2 words, over time. Strongly committed to bringing down inflation to 2% over time. That is our goal, and we will achieve that goal. The statement about over time means we know we're not likely to get this done in the short run. We know we may have to endure higher inflation for longer. We know that we can't be super hawkish and drive the market into a total meltdown because we have this preconceived notion that coming out of a pandemic where there was $3 trillion injected into the economy, that we're going to be able to sustain 2% inflation easily. This last percentage point of inflation, this last 3% to 2% is going to take some time, and we're willing to do it over time. And boy, the markets responded really positively to that sentiment, really positively to the Fed not pushing so hard to drive the 10-year back up to 5% and to drive mortgage rates back up to 8%. Market responded very positively, and we saw interest rates improve on the day, and we close out this week regaining a lot of the ground that we had lost last week. This is really excellent news, and maybe a sign that our Fed is starting to understand the implications of their hawkishness and the fact that they're going to have to endure here a little bit in order to get inflation down to the target. Inflation is still coming down. It's just not coming down as quickly as they would like. It's not coming down as quickly as any of us would like. but ultimately you don't want to break something in order to fix something, right? You want to make sure that we implement a solution or a strategy that is good for all markets, including and especially housing. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.